Hi there, I'm Edward Galstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're diving into Mastercard, one of the biggest players in the global payments industry. We're going to break down Mastercard's stock using the 5 key factors to determine whether it's undervalued, fair valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable MOAT. Be sure to like and subscribe. Now let's dive in. The first thing we want to see in any great business is smart capital allocation. Ideally with a return on invested capital and return on equity ratio that is above 15%. Mastercard nails this with return on invested capital at 41.4% and return on equity at 190.6%. These numbers are stellar, and the trend over the past decade shows steady improvement, with a temporary dip in 2020 during the pandemic. Quick note on the return on equity. It's inflated due to Mastercard's aggressive share buybacks, which shrink equity. So in this case, return on invested capital gives us a more realistic picture of the company's capital efficiency. And by that measure, Mastercard is top tier. Now let's talk about growth. And Mastercard shows impressive momentum here too. Over the last decade, revenue grew at a compounded annual growth rate of 12.6%. Net income grew at a compounded annual growth rate of 14.5%. Earnings per share grew at a CAGR of 17.1%. finishing 2024 at $13.9. Mastercard commands roughly 24% of the global payment market share. And with digital payments expanding due to mobile wallets and e-commerce trends, it's well positioned. Emerging markets represent a major opportunity, and Mastercard also makes strategic investments there. The industry itself is expected to grow at around 5% annually through 2028. And Mastercard's tech-forward approach from AI to blockchain should help it ride that wave. Now on to the balance sheet. Mastercard currently holds $8.8 billion in cash and $19 billion in total debt. So while cash alone doesn't cover liabilities, we need to look deeper. Because of share repurchases reducing equity, traditional debt-to-equity ratios aren't very helpful here. Instead, we turn to net debt to free cash flow, and this is where Mastercard shines. Their free cash flow is strong enough to pay off net debt within a year and has been for over a decade. That kind of consistency points to disciplined financial management. Let's check out Mastercard's valuation. Right now, Mastercard is trading at a price-to-earnings ratio of 37.2 compared to the S&P 500's PE ratio of 26.3. At first glance, that seems expensive, but here's the context. Mastercard's earnings per share has grown at 17.1% annually over the last decade, nearly double the S&P 500's 8.9% growth rate. Peter Lynch famously said that a company might be undervalued if its growth rate exceeds its price-to-earnings ratio. Mastercard doesn't quite pass that test because quality businesses like this that operate in a duopoly rarely trade at bargain prices. Historically, Mastercard commands a premium valuation, often trading above its main competitor, Visa. Why? Because its earnings per share growth has outpaced Visa's, 17.1% versus 15.9% over the past 10 years. Still, if market volatility pushes Mastercard's price-to-earnings ratio closer to 30 or below, that could provide a more attractive valuation. Mastercard's moat is deep and wide. Its network processes over 200 billion transactions annually across more than 200 countries and territories, making it nearly irreplaceable in the digital payment space. Its strong brand, trusted infrastructure, and deep relationships with financial institutions make it hard to disrupt. Scale gives it powerful data and cost advantages, while regulatory approvals act as a barrier to new entrants. Although Mastercard benefits from digital wallets like Apple Pay, which increase transactions on its network, there's a longer-term risk from tech companies creating closed-loop systems that bypass traditional card networks. Since Mastercard doesn't issue cards or offer credit, it relies heavily on transaction volume, making it vulnerable during economic downturns. Regulatory pressure around interchange fees, which are small charges that merchants pay to the customer's bank every time a credit or debit card is used for a purchase, also poses a challenge. While its moat is strong today, Mastercard's long-term advantage depends on its ability to innovate and adapt in a fast-changing payments landscape. Now, before we conclude on Mastercard, you may have spotted in the charts shown in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. In my view, Mastercard stock is fair valued based on the 5 key factors. Mastercard delivers solid returns on capital with a 41.1% return on invested capital ratio, showing strong financial efficiency. Earnings per share grew at a compounded annual growth rate of 17.1% over the last decade, which is very impressive. Debt is well managed with free cash flows that can easily pay down net debt in each year in the last decade. At a price to earnings ratio of 37.2, it's not cheap, but with ongoing trade tensions, it's one to watch. At a lower price to earnings ratio of around 30 or lower, it could offer better value. Mastercard's global payments network is a major strength, but its future depends on adapting to the fast-changing digital payments world. So is Mastercard a future compounder or already priced to perfection? Let me know in the comments. And if there's another stock you'd like me to cover next, drop that below as well. Thanks for watching, and I'll see you in the next one.